Morning, everyone. Thank you for taking the time to join us for our webinar on UAE corporate tax. Just to begin with an introduction, my name is Shiraz Khan. I'm the head of Al-Ghanimi's tax practice across the Middle East and North Africa. And I'm joined by my colleagues, Janet Gui, who's a senior associate in the tax team, and Yanis Nanos, who's a transfer pricing advisor within the tax team as well. For those of you that don't know about us, we're the largest law firm in the Middle East region. We operate in all the GCC countries and also Egypt, Iraq, Jordan, and Morocco. We're a full-service law firm, and one of our practices also includes tax. We set up the tax practice in 2017, and we were the first law firm to set up a tax practice across the region. And currently, we're the largest tax practice across the Middle East region. We cover all areas of tax, including corporate tax, withholding tax, excise tax, customs as well, across the entire region, including the UAE. Slide, please. So just to concentrate on the agenda for today, a lot has happened, of course, with the introduction of corporate tax. It's a major change to doing business in the UAE. And given the developments over the past year, from the moment it was announced, we thought it'd be good to have a session with you just to give you an indicator of what's going on and where we're at. So the agenda for today is just to give you an introduction about corporate tax, why it was introduced, to walk you through an overview of the corporate tax regime, which will be introduced in the UAE. And also discuss the impact it'll have on you as businesses, and also what you should do to get ready and be compliant with corporate tax once it is introduced, and even before it's introduced. Next slide. Just before we start, just some housekeeping points. The audience is muted. Please do submit questions via the Q&A function. Of course, we'll have a Q&A session at the end of the presentation. If we don't get the chance to address your questions, we will respond to you by email. So please do take the opportunity to submit any questions if you have any. If you can't hear us, please make sure you're connected to the audio by clicking on the Communicate tab on the top of the screen and choose to either connect through your computer, audio, or phone. There will be some poll questions, so be ready for them towards the end. We will make a copy of the presentation available for everyone. So after the session, we'd appreciate your feedback, and of course, we'll share a copy of the presentation. So just before we talk about the introduction of corporate tax, I wanted to give you a flavor of the current tax regime in the UAE from an income tax perspective. Of course, currently, we don't have any federal corporate tax. We do have corporate tax at the Emirates levels. So 5 Emirates have a tax which is imposed on businesses, but in practice is only enforced on oil and gas companies which operate inside the UAE. There's also a separate banking tax which applies to branches of foreign banks. And again, that's at the Emirates level. In terms of individuals, there's no personal income tax. And of course, there's many free zones here, around 40, 50 free zones with tax holidays of 5 years to 50 years. And of course, because there's no corporate tax at the federal level, there's no withholding tax as well. But over the past 5 years, there's been a lot of tax reform, as you can imagine. So going back 6, 7 years, a lot of GCC countries were thinking about how do they diversify their income away from hydrocarbons. The oil and gas prices dropped, and therefore they were looking for alternative revenue streams, and tax was a major focus. And at that time, the UAE did give thought to the introduction of corporate tax, but they decided to pause because they decided to introduce indirect taxes, with excise tax being the first indirect tax introduced in the UAE in October 2017, and value-added tax following on the 1st of January 2018. The IMF had said that GCC countries would generate around 2.5% of GDP through value-added tax, and of course, there was significant revenue generated from the introduction of value-added tax and excise tax. A tax authority, of course, was set up and to deal with the taxes, and I'll come on to that a bit later on. Move on to the next slide. So just to give you a flavor of why corporate tax was introduced, you have to be aware of the bigger picture. There's been a lot of international developments going on for the last 10 years, and it all stemmed from a recession which happened in 2008 and 2009. So there was a global recession, as you may be aware, and governments went into budget deficit. And most countries, in order to fund their government expenditure, they rely on taxes. Tax is the main revenue generator for countries. So countries being in budget deficit, obviously tax became a key focus. So a lot of the G20 countries were worried because there's many multinational organizations operating cross-border across a lot of jurisdictions and shifting their profits from high tax countries to low tax countries using the tax rules. So using hybrid entities, hybrid instruments through arbitrage, through double dipping. So they were effectively artificially shifting the profits. They were also using double tax treaties, which were in place to eliminate double taxation. However, they were being used by multinationals to pay no tax in any jurisdiction, and this wasn't the purpose of them. The G20 countries approached the OECD, which is an organization focused on tax reform based in Paris, to look at ways how the tax avoidance could be tackled, and how they could increase tax transparency and also information exchange. The OECD recommended 15 action points to deal with this tax avoidance, which primarily focused on taxing based on where the value is, and again, increasing transparency and information exchange, and of course, minimizing artificial structures. Next slide. So the UAE is actually an OECD BEPS inclusive member, so it's made a number of commitments to international agreements to comply with these agreements, including the implementation of 4 minimum BEPS standards as well. The UAE also introduced substance regulations, as you know, and is very committed to complying with international standards and best practice. Just move on. So what was the driver behind the introduction of UAE corporate tax? As I mentioned at the beginning, tax is a major revenue generator for governments. Most governments, they generate their revenue solely through tax. Of course, this region has been blessed with a lot of natural resources, and historically they've had revenues from hydrocarbons. And in recent years, they've been looking to diversify that. And that led to the introduction of value-added tax as well in the past, and was also contributed to the introduction of corporate tax. Of course, there's lots of government expenses. They need to fund education, they need to focus on infrastructure, healthcare, and all of this involves money. And there's many other expenditures as well. So that was one of the reasons. But as I mentioned, all these global developments which were happening, this is actually the main reason. With the global developments that were happening, the 15 action points the OECD recommended, which was part of the BEPS project, it led to a BEPS 2 project, which had 2 pillars. Pillar 1 dealt with the allocation of taxing rights. And Pillar 2 dealt with the introduction of global minimum tax, corporate tax. And the consequence of the UAE not doing anything would have been that companies based in the UAE would have been taxed in another jurisdiction purely because the UAE had no tax. So the UAE was faced with a choice. Of course, the UAE has the right to have no tax to attract foreign investment here. Where the companies based here are going to be taxed in other countries because UAE is not taxing them, of course, it's better for the UAE to tax them and generate the tax revenue for them because they'll be taxed elsewhere anyway. So this was the primary reason for the introduction of corporate tax in the UAE. Of course, the UAE was faced with the choice whether they focus on those organizations which are affected by Pillar 2, or they have a more wider corporate tax applicable to everyone. And of course, they followed the latter route, which makes sense. The next slide. So I just wanted to also talk to you about, what is corporate tax, and in order to understand what corporate tax is, you have to understand the distinction between direct taxes and indirect taxes. And corporate tax is a form of direct tax, and indirect taxes include taxes such as VAT and excise tax. The difference essentially is a direct tax is imposed directly on a person. It could be a natural person, an individual, or it could be a legal person, and it's imposed directly on your income. So it does impact you. You pay tax directly on your income. On the other hand, indirect tax is not a tax which is imposed on a person. It's imposed indirectly on a person, but through a transaction. So for example, VAT applies to the supply of goods or services. It doesn't apply on a particular person. It applies on a transaction. Ultimately, it's borne by a person, but indirectly. And this is the main distinction between the two. Direct tax is usually a direct cost for you. It hits your bottom line, whereas indirect tax it's not supposed to be a cost to you. It can be in some cases. Of course, there is a compliance burden, but indirect tax is something which you collect on behalf of the government. Next slide, please. And in this example, as you can see, the way value-added tax works, is that it's collected at each stage of the value chain, so starting from production all the way to distribution, to the ultimate sale to the final consumer. It's collected by the business at each stage on the value added at each stage. And the business will collect the VAT on the supplies making to the next person in the chain and remit the tax to the tax authority, and they get it at the time of the supply on the value added at that level of the chain. So in this example, as you can see, the factory is collecting 5, the wholesaler is collecting 5 at that stage, the retailer is collecting 10. A total of 20 has been collected. A total has been collected, or of 20 has been collected by the tax authority, and the consumer at the end is paying 20. So it's all being borne by the ultimate consumer, and it's been passed on, but it's been collected by businesses at each stage of the supply chain. And that's why it's very efficient for the tax authorities. They don't need to wait till the end. They get it in regular stages, and each person has the obligation to collect the tax on behalf of the tax authority, and they collect it from the next person, their customer. Next slide. On the other hand, as I mentioned, corporate tax is a direct tax. It's imposed directly on the income which is taxable. So you simply apply the tax rate, the taxable income, and you arrive at your tax liability. Again, a direct cost to the business. Now, just to give you an introduction about the tax regime in the UAE, of course, UAE is a regional hub, a regional business hub, and it's also an international financial center. And this is one of the major reasons why there was no federal corporate tax in the past. But in introducing corporate tax, of course, the UAE has taken into account its role as an international player, international financial center, and it wants to continue to attract investment. It wants to have a simplified regime. It wants to reduce the burden on businesses, provide certainty to businesses, and all of these objectives are being taken into account in coming up with a regime which will be applied in the UAE. And also with any corporate tax system, and the best practice is that the corporate tax system, as I mentioned, should be certain when foreign investors are coming to do business in your jurisdiction. They should have certainty on what taxes are applicable, and how to comply. It should be simple, easy for them to follow. It should also be neutral, and it should be equitable. So for example, if you have smaller businesses, they should pay less tax. If you have larger businesses who have higher revenue, they should pay more tax. And of course, there should also be transparency as well. The tax authority should provide information, give guidance to the businesses to help them comply, and should ensure that the tax law is applied fairly. And of course, all of these factors have again been taken into account in devising the corporate tax regime. Now, how is the legislative framework going to be in the UAE? So of course, we have a federal tax authority, and this was established by law in 2016. It became operational in 2017 when people from the Ministry of Finance transferred, and is charged and with the responsibility of managing, enforcing, and collecting all federal taxes. The first two being value-added tax and excise tax, and of course now the third federal tax being corporate tax. So in terms of where we are at the moment, of course, January last year, there was an announcement by the Ministry of Finance that corporate tax would be introduced. At that time, they gave us some limited guidance on how the regime would look like. This was a reflection of the policy decisions which were taken by the UAE in implementing corporate tax. Then later on in April, there was a 3-week consultation period where businesses were given the opportunity to provide feedback on the rules. And as part of that process, we were given additional information on what some of the detailed rules might be. And again, these were at the policy level. At that time, these were not the rules, and these policies could change once the legislation was issued. Then, of course, in December, the legislation was issued. We have the corporate tax law, which has been published already. Corporate tax law will only be part of the picture. So there are around 40, 50 other areas where further detail will be made available, either through cabinet decision, ministerial resolution, or FTA decision. So we don't have the full level of detail available now, and that's important to be aware of. And of course, we already have a tax procedures law and regulations in place, and these will also govern federal corporate tax. There are expected to be some amendments to take into account corporate tax, but this just provides a framework. There'll be further procedures which will be provided through all the secondary legislation which I referred to. And in due course, of course, when the law is enforced, and even before that, there will be guidance from the tax authority in the form of guides, clarifications, and etc. So what would the corporate tax law look like? Of course, we need to have an effective date. From when will it apply? Who is it going to apply to? Who is it not going to apply to? Who's subject to tax? On what basis? What the tax rates should be? How to calculate the tax? What kind of reliefs will be available? Will there be a concept of groups? How will free zones be treated? Some transfer pricing rules, and of course, foreign tax credits, and then the compliance and litigation and appeals, which is already partly dealt with in the tax procedures. So when will corporate tax be applicable? So the corporate tax law is already effective. It was effective 15 days after it was published in the official gazette, but it won't apply to you as an organization. It will apply to you depending on when your financial year starts. So it applies to companies that have financial year starting on or after 1st of June 2023. So if your financial year starts on the 1st of July, it will apply to you, and your first financial year will be 1st of July 2023 to 30 June 2024. On the other hand, if you have a calendar year financial year, it will not apply to you until the calendar year of 2024, 1st of January 2024 to 31st December 2024. And of course, you need to register before that, but some of the compliance will be later on, as Janice will discuss. Next slide. So who's going to be subject to corporate tax? And I think first of all, it's important to understand who's going to be excluded or exempt. So there are certain persons who are going to be excluded and exempt. And even before I go on to that, I just wanted to clarify that, of course, it's being referred to as corporate tax, but it's a little bit misleading because it's not really a corporate tax. It's actually a business tax or income tax on businesses. Because it doesn't only apply to corporates, it can also apply to individuals as well. So in terms of who's excluded, there is an exclusion for federal and Emirates level governments, government bodies, government institutions. There's also an exemption for government-owned and controlled entities that carry on a mandated activity which is prescribed to them by legislation. There is also an exclusion for oil and gas companies because under the UAE constitution, the right to tax oil and gas entities in the production and exploration sector is with the Emirates. Therefore, in line with that, these entities will be exempt if they're subject to the Emirates level taxation. Also, certain qualifying public benefit entities will also be exempt. So, for example, charities, and you you have other non-profit organizations, they'll also be exempt, as well as qualifying investment funds and pension funds and social security funds. Now, some of these exemptions are going to be automatic, for example, to the federal and Emirates government. Some are going to be subject to a cabinet decision. So certain government-owned entities are either wholly owned or controlled by the government, and also qualifying public benefit entities. These will have cabinet decisions which will set out the conditions and also perhaps the entities which will be exempt pursuant to the cabinet decision. And then there's of course other entities, and this could also include government-owned subsidiaries who are not under cabinet decision, but you could actually apply to the Federal Tax Authority for exemption, as well as qualifying investment funds and qualifying public benefit funds. For oil and gas companies that are subject to the Emirates level tax, they'll have to notify the tax authority. So I think that's it in terms of exclusions. Now, if we go into the next slide and focus on who does it actually apply to. As I mentioned, in terms of natural persons, they'll be excluded from tax to the extent that they don't do business in the UAE. So if they have personal income like salary, employment income, other personal investment income from dividends, capital gains, investing in real estate, all of this should not be subject to tax because this is their personal income. But on the other hand, if they're doing business, then they will be taxable in the UAE. Now, how will companies be taxed in the UAE? And essentially, companies will be taxed if they're resident here, and on the other hand, also if they're non-resident here. So firstly, dealing with the residents. The resident companies will be taxed in the UAE on a worldwide basis. So if you're considered a resident in the UAE, you'll be taxed in the UAE regardless of wherever you earned your income. If you received income from the UK, from Japan, from China, it will all be taxed in the UAE if you're resident. So how do you determine residency? So first of all, if a company is incorporated in the UAE, it will be considered automatically as a resident in the UAE. And in certain circumstances, even for companies which are not incorporated in the UAE and are incorporated in another jurisdiction, they'll be considered as resident in the UAE if they're effectively managed and controlled in the UAE. And there's no guidance in terms of what is effectively managed and controlled, but there's a lot of international guidance out there. There was a case a long time ago which dealt with this principle called De Beers, and it said effective management is all about effectively where the strategic decisions of the company are taken. So where the board or where the board of directors meet, where they take their decisions. And in other cases, it's about where the actual operational management is. So it's basically to do with the management of the company. So you could have a situation where you're a non-UAE company, but you have directors sitting here taking decisions about the organization, conducting board meetings, and that non-UAE company could come under the UAE tax net and be subject to tax on worldwide income. Next slide, please. In terms of non-residents, how will they be taxed? And essentially, non-residents, in line with the international approach, will be taxed in the UAE if they carry on a business in the UAE through a permanent establishment. And also, they'll be taxed in the UAE, in theory, if they don't have a permanent establishment in the UAE, but they generate UAE-sourced income. Except that, in the meantime, there'll be no tax, and I'll come on to that in a short while. But in terms of, when you don't have a permanent establishment, when will you be considered to have UAE-sourced income? If you're receiving a payment from a UAE resident person, or effectively, if you're receiving the payment which is connected to activities, assets, or deposits inside the UAE, or otherwise you perform services inside the UAE, the benefit of the services or the services are exploited inside the UAE, or relates to rights which are exercised and used in the UAE. Go on to the next slide. Now, in terms of what is a permanent establishment, if you remember, I said if you're a non-resident, initially the only way you will be taxed if you have a permanent establishment in the UAE. And on what will you be taxed? You'll be taxed based on the profits which are attributable to the permanent establishment. And this is going to be based on transfer pricing. So you have to allocate some profits. You have to treat the permanent establishment as a separate entity, an enterprise, and allocate some profits to it accordingly. And I think Yanis will come on to transfer pricing later on. But essentially, a permanent establishment is in line with the international approach. So if you have a fixed place of business through which you carry on a business, you're considered to have a permanent establishment. If you have an office, branch, factory, you'll be considered to have a permanent establishment in the UAE. If you have people on the ground for a prolonged period of more than 6 months, you'll be considered to have a permanent establishment. If you carry on activities which are preparatory and auxiliary, which are generally before you're carrying on a business, like marketing, product development, getting customer feedback, that will not be considered as a permanent establishment. If you're displaying goods on display, then in that case also. In the absence of a fixed place of business, you could also have a permanent establishment in the UAE if you have a dependent agent. And a dependent agent is where you have an agent in the UAE who's effectively carrying on the business on your behalf. So they're taking the decisions, they have the ability to bind you on a habitual basis. They're taking decisions which are effectively binding you as an organization. So therefore, you'd be considered to have a dependent agent, and therefore you'll have a PE in the UAE and you'll be taxable. And also, the law mentions that any other form of nexus in the UAE, and it says it's going to specify in the cabinet decision. A lot of countries have moved on to the concept of nexus or personal income tax. This is a fairly new concept, and it's not clear what this means at the moment. My personal expectation is that this could potentially be a force of attraction. So in certain circumstances, even if you operate in the UAE, without having a permanent establishment, if you have some kind of link with a permanent establishment, the income you're generating, other than through a permanent establishment, if it's linked to the permanent establishment or an agent, then that income could also be brought under the UAE tax net, be taxable. But this remains to be seen. Now, as I mentioned, in certain cases, if you're non-resident in the UAE, you'll be taxed through a permanent establishment, and you will not be taxed initially if you have UAE sourced income, because initially, there will be no withholding tax, or more rightly, withholding tax will be applied at the 0% rate. So withholding tax is actually an income tax which is imposed on the income of the non-resident. However, the obligation is on the resident or local payer to withhold and remit the tax on behalf of the non-resident to the tax authority. The UAE has taken a decision that initially the withholding tax rate will be 0%, which is why non-residents will not be taxed if they don't have a permanent establishment and still generate UAE source income, at least initially. Now, in terms of the tax rates, the standard tax rate will be 9%, which will apply for taxable income above 375,000. There will be a lower tax rate of 0%, which will apply to smaller businesses and startup businesses that don't have enough revenue or revenue below 375,000 as well. The law doesn't deal with set out any other tax rate, but there is expected to be further legislation. And in line with the BEPS Pillar 2 proposal, there will be a different tax rate which will apply to those large multinationals which fall under the Pillar 2 criteria. And as I mentioned, you're multinational if you operate in 2 or more jurisdictions, and you're a large multinational according to this criteria if you have global consolidated revenue of more than 750 million euros. Of course, there's no clarity at this stage. It will be a minimum rate of 15% based on current status of what's going on globally. The rate can be higher, but it's expected to be around 15%. And one other point I wanted to make, a number of people ask, why was a 9% rate decided? Of course, there's 2 reasons. First of all, the UAE wants to stay competitive. 9% is one of the lowest rates in the world. It's the lowest rate in the region. If you look at Saudi, 20%. If you look at Kuwait and Oman, 15%. If you look at Qatar, it already has 10%. So 9% is the lowest rate. There was also another reason, as I mentioned, under the BEPS proposals, there was a concept where if you're receiving income from another country where the payer is paying you, And if UAE had a tax rate of less than 9%, there could have been prohibitive withholding taxes, higher withholding taxes. So therefore, a minimum 9% corporate tax rate had to be maintained. And that was another reason. We move on to the next slide. So I'll hand over to Janet now, who will talk you through the taxable income.
Thank you, Shiraz. Now, in this section, I'm going to touch on how you determine your taxable income. So as you've heard from Shiraz earlier, the tax is imposed on your taxable income. So meaning to say that it is not necessarily that all the gross revenues of your company is subject to tax. However, under the corporate tax law, there are certain adjustments that you can make to your income to arrive at this figure of taxable income that would then ultimately impact the amount of tax that you pay. So the starting point is we'll take the accounting net profit or loss as per your financial statements. Now, your financial statements need to be prepared using acceptable accounting standards and principles in the UAE. So, for example, IFRS is widely accepted here. Financial statements could follow that. Now, your tax period would also follow your financial year. So, as Shiraz mentioned earlier as well, if your financial year, for example, begins on the 1st of January 2024 until 31st December 2024, that will be your first reportable tax period. However, if for example, your financial year begins on the 1st of July, then the first tax period will begin 1st of July this year. Now, we're expecting to see further guidance on how the corporate tax return should look like, but the law will give you an idea of how we calculate your taxable income. Now, it is important to understand how you arrive at taxable income because, as I've mentioned earlier, this affects, ultimately the amount of corporate tax that's payable. So when we look at the starting point, we take your net accounting profit or loss as per your financial statements. Now, there's certain adjustments that you can make to your income, and I'm going to touch on these items in the next few slides. Now, the idea of today's session is just to give you an overview and sort of the key aspects of what you need to know for each of these items. So, there's quite a lot of detail on these aspects. So, I'll highlight some of these key takeaways for each of these adjustments that you could make to your taxable income. Now, the sort of adjustments that you can make to your income is you take into account unrealized gains or losses, your exempt income, so income from your dividends and profit distributions, for example, could be treated as exempt, subject to certain conditions. Restructuring relief between your group companies, of course, again, there's certain conditions that needs to be met, but this could be treated as a no gain or no loss situation. And of course, certain expenses could also be deducted for tax purposes. And Yanis will touch on this section later. You need to also take into account any adjustments that have been made for transfer pricing purposes. You could also take into account any relief that's been claimed in terms of tax losses, and as well as incentives or special reliefs that are granted for a qualifying business activity. Now, we don't know what these activities that would be determined as qualifying business activities at this stage. So, it's something to keep an eye out once we have further detail on this. And the minister as well could make any other adjustments to the taxable income. Now, once you arrive at the taxable income, the first bracket of taxable income of up to 375,000 would be subject to 0% tax, and any amount taxable income that exceeds that would be subject to 9%. Now, when you arrive at your corporate tax liability, you could then at the end deduct any withholding tax credit that's applicable or foreign tax credit, as well as any other incentives that could be determined. And after that, you arrive at your final corporate tax payable. And Shiraz, I believe you wanted to add on something.
Yeah, I just wanted to say, as Janet mentioned, your starting point is your net accounting profit. And as with other jurisdictions, you have to adjust your net accounting profit for tax purposes, because there'll be certain income which is not taxable, and there's also certain expenses which will not be deductible. So therefore, you have to take that into account and adjust it. And as far as your net accounting profit is concerned, as Janet mentioned earlier, it's going to be based on your accounts, which have to be prepared under acceptable GAAP. I think Yanis will touch on the requirement for audits later on. I think an important point to mention is that usually, accounting depreciation is disallowed, and for tax purposes, you have specific rules for depreciation or capital allowance, sometimes they call it. In the UAE, there doesn't seem to be, at least for now, a special regime for tax depreciation or capital allowances. So therefore, it looks like the depreciation in the accounts will be accepted. Thanks, Janet.
All right, so one item that will be treated as exempt is essentially what we call the exempt income. And this is, there's certain types of income that we've categorized in 4 different buckets, I'll put it that way, that wouldn't be taken into account when calculating your taxable income. So the first sort of bucket is, any sort of dividends or profit distributions that you receive from UAE resident companies, that's treated as exempt. Now, your second income then is your income that's derived from participating interest. Now, under the law, they've defined participating interest and attached many conditions to it. But one of the key aspects that you need to know is that if you hold at least 5% ownership interest in another company for an uninterrupted period of at least 12 months, that would qualify as a participating interest. Now, in terms of what sort of income would be treated as exempt, now dividends and profit distributions from participating interests in foreign companies would be treated as exempt, and any capital gains from the transfer, the sale of participating interest would also be treated as exempt. Now, there's a misconception, a general misconception in the market that, this capital gains from participating interest only applies to non-resident companies. What about UAE resident companies? How is that treated? Is it exempt as well? Now, the answer to that is yes, it is, as long as it meets the participating interest conditions. So just to recap, capital gains from both participating interest in both UAE and non-UAE entities would be treated as exempt. Now, the third sort of bucket as well is income from your foreign permanent establishments. Now, I'll touch on this later on, but essentially, a UAE resident entity can elect to treat any income from its foreign permanent establishments as exempt. Now, the fourth bucket then is any income that's derived from operating aircraft or ships in international transportation industries. So this extends to both non-residents and UAE residents.
Just a couple of other points I wanted to make. As Janet mentioned, the domestic dividends will be exempt, as will dividends from participation, whether it's domestic or foreign. And the thinking behind this is that dividends are paid after you pay the tax. So the income from which you pay the dividends are already taxed. That's why this is in line with very much international practice, as some of the other exemptions. And I think earlier on I talked through some of the exempt persons. Now this is exempt income. And another thing I wanted to touch on, which I didn't under exempt persons, was the tax position of banks. Because as I mentioned, banks are currently being subjected to Emirates level taxation if they're a branch of a foreign bank. There is no exclusion for them under the federal corporate tax. So that would mean that banks, even if they're paying Emirates level tax, come under the scope of federal corporate tax, will have to pay federal corporate tax. But at the same time, they're currently subject to Emirates level taxation. So what will happen? I don't see an exclusion for them from federal corporate tax, because there's no such right for the Emirates to tax them under the constitution in the same way as oil and gas. So the key question remains is how the Emirates level tax will work. Also, we have an indicator that there'll be no credit for Emirates level tax against the federal corporate tax liability. So the key questions are whether the Emirates level taxation on banks will continue. That's number one. And number two, if it does, whether there'll be a credit available against the Emirates tax liability for the corporate tax paid under the federal corporate tax regime. And the third option, obviously, is the tax under the both, but it still remains to be seen. Thanks, Janet.
Yeah. So as I mentioned earlier, there is this concept of a participating interest. So any income that's derived from participating interest, and you meet the conditions. So the key things to note are that you need to own at least 5% ownership interest, as well as holding this interest for an uninterrupted period of 12 months. That will qualify you, to treat the income as exempt. Now, as I mentioned earlier, if you recall, the third bucket of your exempt income is essentially you can elect to treat any income from your foreign permanent establishments as exempt. Now, the thing with this is that once you make this election, it is going to apply to all your permanent establishments that are not in the UAE. So say, for example, you're a UAE company, you have a branch in country A and as well as country B. What's going to happen is that once you make this election, all the income from country A and country B will be treated as separate independent persons, and this exemption would apply to your branches in country A and country B as well. Now, in terms of expenses, for corporate tax purposes, you could make a deduction, claim a deduction for expenses that you incur. Now, that does not cover any sort of expenses. It needs to be wholly and exclusively incurred for your business, and it cannot be capital in nature. Now, the thing about the deductible expenses is that because it reduces a portion of your taxable income, it's quite often subjective views. So it has always been a major source of controversy, between tax authorities and taxpayers in the region. Now, when it comes to, claiming a deduction for your business expenses, it's very important to make sure that you have a sufficient audit trail documented. Make sure that you have enough documents to justify the nature of this business expenses, the amount of business expenses that's being claimed. So this needs to be in an organized manner as well, so that you be able to retrieve this data quickly. So once you have all of that, then you'll be able to claim your expenses as a deduction. Now, as I mentioned, not any sort of expenses are just deductible. There are certain restrictions, and they're prevented from claiming expenses if they don't relate to your business, such as exempt income. Non-business losses, you're not able to claim either. If you make donations to non-approved charities, that's not deductible. Fines and penalties, bribes, illegal payments, dividends, any amounts withdrawn from the business by UAE national persons, corporate tax, any tax that's payable, your income that's recoverable, as well as any other expenditure that can be determined by cabinet decision is non-deductible. Now, unlike VAT, where there's just a block on any VAT that relates to your entertainment expenditure, for corporate tax purposes, you're allowed to claim a deduction, for entertainment expenses, such as your meals, your accommodation, and any sort of expenses that you use to entertain your customers, your business partners. But you need to note that there is a cap on this, and it's 50%.
I think the other point I wanted to make is that what about where you have expenses which are effectively partly for business purposes and partly for non-business purposes? And obviously we understand the concept is that you're only allowed a deduction for those expenses which relate to income which is taxable, and also the expenses need to be wholly and exclusively for the purpose of business. Of course, where you incur an expense which is partly for business purposes or partly for non-business purposes, it cannot be wholly and exclusively for business purposes. I think there has been some guidance suggesting that there should be an apportionment, but there is an inherent contradiction in the concept because, of course, when you have one expense which is partly for both, it cannot be wholly and exclusively for the purpose of the business. This is a bit of a gray area, although the guidance is you do an apportionment and the part of the expense which relates wholly and exclusively for the business purposes should be deductible.
Yeah. So just a quick one on this. You'll also be able to deduct any interest expenses. Now there is a cap that is limited to 30% of your accounting earnings for interest, tax, depreciation, and amortization, so your EBITDA, basically. Now, an exception to this rule is that this rule does not apply to banks, insurance businesses, and as well as any businesses that's carried on by individuals.
This limitation will only apply for entities who have net interest expenditure above a certain threshold, and this will be announced. This threshold will be announced later on in a subsequent decision.
Yeah. Moving on, under the corporate tax law as well, if you remember, before arriving at taxable income, you can also make allowances and claim reliefs, where you have transfers of assets and liabilities or any sort of restructuring between what you call a qualifying group. Now, this qualifying group concept is essentially, any of the transferor or transferee could be a UAE entity or a non-UAE, permanent establishment of a non-UAE entity in the UAE. Now, in terms of ownership, it needs to be at least 75% ownership, either directly or indirectly by both companies, or common ownership by a third person. Now, in the group as well, you can't have any entities that are exempt persons or qualifying free zone persons, and they need to have the same financial year and apply the same accounting standards. Now, once you've established this qualifying group, any sort of transfers of assets or liabilities between the members of this qualifying group then would be treated as a no gain, no loss. So essentially, the transfer will be treated at a net value. Now, there is a clawback to this. So in case the assets and liabilities are transferred outside of the qualifying group, then, essentially what happens is that this transaction will be treated as market value. And if at any point within this 2 years, the entities within this qualifying group cease to become members, then, again, the transaction will be clawed back. So the transfer will be treated at market value instead. Now, there's another form of restructuring relief. I won't touch in, too much detail, but essentially it also applies to transfer of businesses within a qualifying group that's in exchange for shares. So again, you have, as long as you meet this qualifying group conditions, and the transfer needs to be taken in accordance with UAE laws, this will qualify you to treat the transaction as no gain, no loss. Now, the clawback to this, again, you cannot transfer any of these shares outside this qualifying group, and you can't, undertake a sort of subsequent transfer within these 2 years. So it needs to stay within the group. Now, when it comes to losses, essentially you can, offset your losses up to 75% of your taxable income for future periods. Now, it's currently unclear, whether there's a limitation to whether you can carry forward these losses indefinitely. At this stage, there's no clarity on this. But one of the conditions is that the shareholders need to be at least 50% the same for the year that you want to claim tax losses, or the same business needs to be carried on by the new shareholders in the tax periods that you want to claim these tax losses. Now, an exception to this rule is, this rule does not apply to public listed companies. Of course, there's some limitations to what, tax losses you can claim. So you can't claim, any tax losses that's been incurred before the effective date of corporate tax, or, the day before you become a corporate, a taxable person.
I think the other point to make is that, I think even if there's a change in ownership, the key thing is that provided you're carrying on the same activity after the change of ownership, you should be able to carry it forward indefinitely. So the first thing is, if you make a loss in a certain year, you can carry it forward in the next year against 75% of the taxable income. If you still have an excess, you could continue to carry that forward indefinitely, provided that there's no change in the business. And again, this is in line with a lot of international laws, which look at, the fact that if you generate losses from a certain business, you should not be able to use those losses against a new business. You can only use them against the same business which you're carrying on.
So there's also this ability to transfer tax losses within, we'll call it your group again. So you have this same sort of similar conditions like your qualifying group, except that both entities would need to be UAE entities. And essentially what that means is that you can use a tax loss in one entity, let's say company one, to offset the taxable income in company two. Now, again, there's a cap on how much tax loss can be offset, and this is 75% of taxable income of the company receiving the transferred losses. So if we take this example here, essentially, if I want to claim the losses of company one, the losses that I want to claim by company two cannot exceed 75% of company two's taxable income. Now, essentially, under the law as well, you'll be able to claim a foreign tax credit for any sort of taxes that you paid on, in foreign jurisdictions on your income or profits, and that can be, credited against your UAE corporate tax liability. Now, the restriction to this is that it can't exceed the amount of tax that's due on your UAE entity. You can't carry forward or carry back, these tax credits, and of course, you need to maintain the necessary records to substantiate, the amount of tax that you've paid in the foreign jurisdiction. Now, if you see the second column as well, you can claim a withholding tax credit. Now, as Shiraz has mentioned earlier, this is not really applicable at this stage because there's no withholding tax. It's meant to apply to, entities that have become taxable persons in the UAE. So essentially, it's, for example, it would apply to if you're non-resident, for example, you've been paying withholding tax on your UAE source income, but you subsequently then become a UAE taxable person, you can use whatever withholding tax that you paid to credit against your corporate tax that's payable. So there's also, restrictions on the withholding tax that you can claim. And any excess of withholding tax credit, would be refunded to you. Now, tax groups. This is different to the concept of qualifying groups that I've mentioned earlier. Now, the benefit of this tax group is that you can make consolidated filings. You need to consolidate your financials, and any sort of intra-group transactions between your group members would be eliminated. Now, the key condition to this is that your parent company needs to be a UAE company that owns at least 95% of share capital, voting rights, as well as the subsidiaries' profit and net assets. Now, all these entities that are part of the tax group cannot be exempt persons, qualifying free zone persons. You need to have the same financial year as well as the same accounting standards. Now, this tax group for corporate tax purposes is different to the VAT groups, where a VAT group has different conditions where you need to have share the same financial, economic, and objectives in that group. Now, the key thing to note as well is that all your group members would remain jointly and severally liable for corporate tax. Now, also, when you form this tax group, you need to make a separate application for this. So that means that if you're a VAT group, that doesn't mean that you automatically become a tax group for corporate tax purposes.
Just a few comments to add to that. So there are two concepts of groups for corporate tax purposes. The first group is this type of group where you need to have 95% common ownership. The parent which creates the common ownership needs to be a UAE entity. So if you have 95% legal ownership, voting rights, income on distribution, then you qualify as a tax group for these purposes. And the other rules which Janet mentioned about transfer of losses and also reorganizations or transfer of assets, those become irrelevant because you'll be filing on a consolidated basis because you're a tax group. And of course, if you don't fall within a tax group under this definition, 95% ownership, then you can still benefit from the transfer of losses to other members who are profitable, and also transfer of assets at no gain, no loss, and also in terms of reorganizations can be done in a tax neutral way, provided you have 75% common ownership. And as Janet mentioned, it's a very different concept for VAT, and of course, there's already TRN numbers for VAT purposes, and the tax group for corporate tax purposes will be different. So presumably there'll be separate tax numbers for VAT purposes and for corporate tax purposes. Okay, so just to touch on free zone persons as well and how they will be treated. Of course, free zones, and there's around 40-50 free zones in the UAE, and they're a very important pillar of the UAE economy. And a policy decision had to be taken on how to treat them. Noting that a number of free zone laws now, some of these are at the Emirates level, and some of them are at the federal level, like the DIFC and the ADGM. They have tax holidays of 5 years to 50 years. The question was, how would they interact with corporate tax? When the initial announcement was made, an indication was provided that free zone persons would not be taxable, provided that they comply with the regulatory requirements and they don't do business with the mainland. Then when the consultation document was made available, we had some additional information, and we were told that, okay, if you comply with regulatory requirements, you don't do business with the mainland, and you don't receive any income from the mainland, you should be subject to 0%. On the other hand, if you received income from the mainland, it would depend on what type of income you receive. We were told if you received passive income, which is interest, royalties, dividends, or capital gains from the sale of shares, or even if you received income from payments made by related parties, you could still be subject to 0%. Then we were told if you received any other income, you'd be subject to 9%, meaning that regardless of the fact that some of the income you receive in that same entity, which is receiving income from the mainland, which is not passive income, is international income, and would otherwise be subject to 0%, the entire income becomes tainted. Now, the law has been issued and it doesn't provide us much additional guidance. There is a distinction made between qualifying income, non-qualifying income. And if you generate qualifying income, you're subject to 0%. If you generate non-qualifying income, that will be subject to 9%, which appears to indicate that there may have been a policy change, and it could be that, for example, certain income benefits from 0% and other income is taxed at 9%. So there's some sort of ring fencing. Whereas previously we were told that everything would be subject to 9% if you didn't qualify. That remains to be seen. There will be a subsequent decision which will be issued, which will clarify what qualifying income is. I think the point to make is that all free zone entities will be subject to corporate tax. It doesn't mean they have to pay corporate tax because they may be subject to 0% corporate tax. It essentially means they have to register and file tax returns. If you go on to the next slide. There's also some other conditions, when you're a free zone person that you need to meet in order to benefit from the 0% rate. You do need to maintain adequate substance in the UAE. There's no definition of what that means, but presumably that means you need to comply with the existing substance regulations. And provided you do that, you should be okay and have sufficient substance in the UAE. But it is something to think about. There is an ability as a free zone entity for you to make an election to be, even though you benefit from 0%, to be subject to 9% as a whole. And of course, if you do that, then you cannot benefit from the 0% rate. I mentioned already, you need to be generating qualifying income. Also, you need to comply with the transfer pricing rules, which means that your transactions need to be on an arm's length basis, and you also need to comply with documentation requirements. And Yanis will talk through that shortly. There's also some other conditions that may be prescribed, I think, by the minister. So that remains to be seen what those other conditions will be. So in terms of where we're at, if you're in the free zone and you're doing business internationally, not generating any income from the mainland, that should be subject to 0%. If you're in the free zone, doing business with other free zones or within the free zone, that should also be subject to 0%. The only question mark is once you start to receive the income from the mainland, are you still subject to 0% on the income you receive internationally, or are you only subject to 9% on the income which you receive from the mainland? And also, for example, are you still subject to 0% on passive income? Of course, previously the indication was that passive income would be subject to 0%. And presumably that policy will go through. So I think the key question which remains is that will your entire income be tainted? And obviously we'll have the answer once the further legislation is issued.
Thank you, Shiraz. So now with regards to transfer pricing, as we have already discussed, transfer pricing regime is going to be part of the UAE Corporate Tax Law. There are a few clauses that relate to transfer pricing, like the arm's length principle, the definition around the related party, the definition of connected persons as well. The interesting thing is that basically transfer pricing is going to follow the guidance from the OECD. So for the ones that are not really familiar with transfer pricing, you can take a step back. So transfer pricing deals with all transactions between entities that belong in the same group. It's not a tax itself, but it's basically it's affecting the taxable basis of an entity. So if you have, in a simple example, in a simple scenario, you have two entities that are based in two different countries, you have a low tax jurisdiction and a high tax jurisdiction, there is always incentive for the group to transfer income from the high tax jurisdiction to the low tax jurisdiction, so you can basically pay less tax. Having said that, tax authorities across the world, they have introduced transfer pricing rules to ensure that this, what I just described before, is going to be avoided. So basically, that's the main idea behind having the transfer pricing legislation, is that tax authorities across the world, they ensure that they retain their fair share of taxes that comes from any transactions between related parties. So next slide, please. In terms of UAE, as I said before, there are a few clauses that relate to transfer pricing. One key concept is the idea of the arm's length principle, that basically requires that all transactions between related parties should be conducted at the market rate. That is a core principle. It is a principle that we have seen in other jurisdictions as well, developed and as well jurisdictions from developing countries. It is also common in the region, in Saudi, Qatar, Egypt. These jurisdictions, they adhere to the arm's length principle. And the good news is as well that UAE is, the transfer pricing legislation in the UAE will follow largely the guidance from the OECD. The OECD, as Shiraz mentioned before, is basically an international organization that sets the global tax agenda, and it's also showing the pace for transfer pricing as well. Many jurisdictions, they follow the guidance from the OECD. UAE doesn't make specific reference to the OECD transfer pricing guidelines, but the way that the law is written and the requirements that are for, as an example, transfer pricing methods or comparability factors, they are reflected as well in the OECD guidelines. Apart from these two areas that basically are quite critical, then we have also to discuss about related persons and connected persons. So next slide, please. So each jurisdiction has its own definition of related parties. What does mean that basically is what is the definition of affiliation. So if you are, what is basically in the law prescribed as an approach to determine if two parties, when they conduct transactions between them, should fall within the scope of transfer pricing. In the UAE, there are basically two areas. One is the related persons, and the other one is the connected persons. Related persons is something we can see also in other jurisdictions. So if you have, let's say, two persons, an entity or an natural person can be connected either through ownership, control, or they can be also connected, related through kinship. So ownership basically means if you have two parties that one party owns 50 or more percent in another party, these two parties are considered related. So coming from this, any transaction between these two parties is considered a related party transaction and it should be priced on an arm's length basis. The UAE, in terms of ownership, have a specific percentage, that's the 50%. Other jurisdictions have different percentages. Also, there is the definition of control. Control is basically when you have one person that is basically exercising effective control on another one. So here it can be the ability basically to determine 50% of the voting rights or 50% of the board of directors. So as you can understand, control takes a different form from ownership. It's a more vague definition, is not explicit as in the way of ownership. The other interesting thing here, and the last, by the way, part in terms of relationship through with related persons is through kinship. So if you have family members up to the 4th degree, any transaction between these persons should be considered as a related party transaction. There is the interesting concept of connected persons. Connected persons is something that we don't easily meet in other jurisdictions. The reason we have connected persons here in the UAE is because there is lack of personal income tax. So imagine that someone is an owner of a business and there are some payments done from the business to that person. In the UAE, these transactions will fall within the scope of transfer price. And the reason for that is because the owner of the business may decide to have foresee excessive payments to him, so he can erode in that way the taxable basis of the business. Having said that, this will have a huge impact in the UAE businesses because there are a lot of businesses that are family businesses. This will not only apply to owners, but to directors and also related persons to the directors and the owners. We can move to the next slide, please. Related party transactions can take any type of form. They can be basically distribution of goods or tangible assets. They can take the form of services when you have management services provided from one entity to another. They can also have the form of financial transactions. You can have a loan or a guarantee between two parties. And it can also be in the form of IP. So basically, when you have granting of IP rights from one entity to the other. We should mention as well that transfer pricing rules apply not only to cross-border transactions, but they also apply to domestic transactions in the UAE. There is no separation in the law, and we should assume that in all cases, transfer pricing rules apply for any type of transaction, and even if it's conducted between parties that are belonging in the same jurisdiction. Next slide, please. So in terms of documenting and basically supporting your transfer pricing approach is basically the law with Article 55 is introducing three types of transfer pricing documentation. The first one is the disclosure form. Basically a form that you need to include all your related party transactions. You need to mention the value. I mean, there is no yet clear guidance on what should be part of the disclosure form, but it is expected, as we have seen in other jurisdictions like Saudi or Qatar, that most likely this will be the content of the disclosure form. The disclosure form will be prepared, and that we know for sure it will be prepared and should be submitted together with the tax return within 9 months from the end of the fiscal year. Again, there are two other documents, the local file and the master file. The local file basically describes the business of the local entity, and it also gives an overview of the related party transactions. The master file, that's more on at the group level. The guidance from the UAE Corporate Tax Law hasn't explicitly mentioned the content, but we're expecting that it will be largely in line with what is in the OECD. Still, there should come some cabinet decisions to decide on the content of the local file and master file. We know that both of these, they should be prepared on a contemporaneous basis, and they should be submitted to the tax authorities within 30 days upon request. The last one is the country-by-country reporting. It already exists in the UAE, and it's basically a form with quantitative and qualitative information about the group. We can move to the next slide, please. So in terms of, just to summarize very quickly on transfer pricing, businesses, they need to consider now before the the application of the corporate tax law already. Firstly, the first thing they should consider is around which are the related parties or connected persons. Sometimes it's very common that there is some confusion around the definition that is given from an accounting perspective. We should always keep in mind that we need to define the related parties and a connected person from a corporate tax and transfer pricing perspective. So that's step number one. Define with which parties you have related party transactions, domestically or cross-border. That's one. Second is basically to see what is the type of transaction you have. You may be providing a loan. You're not asking for interest. It doesn't mean that there is no transaction there. So you need to consider about the type of transactions you are having, classify the transaction properly in an appropriate way. And the last stage is basically determining the pricing of these transactions. So in order to do this, you need to perform, as we call it, an economic analysis or a benchmarking analysis. Identify comparable data at a company level or at a transactional level, and determine an appropriate pricing for that related party transaction. Once this has been done, then at a later stage, you can start already preparing your transfer pricing documentation. But as an initial stage, is basically companies need to identify the related party transaction and see what is the appropriate price. And as we mentioned before, transfer pricing rules, there are a few clauses in the law, but the whole law, because it makes reference to the arm's length principle, Shiraz discussed before about the free zone companies, there is a reference on arm's length price on the transitional rules, interest deductibility, business restructuring reliefs. So we should always keep in mind that transfer pricing is at the core of the corporate tax system in the UAE, and is basically one approach, one way to ensure that companies will have to pay their fair share of taxes. Next slide, please. So in terms now of compliance and administration, this relates basically in terms of preparation for the corporate tax return. We know now that the registration for corporate tax is open. FTA has released as well a manual on how to register. Companies, they have to prepare their financial statements in accordance with their relevant regulatory requirements. The tax return should be prepared and filed within 9 months from the end of the fiscal year. Hopefully, there are no advance payments in the UAE, so someone can pay their tax at the end of within that 9 months. Companies also, they need to maintain their supporting documentation for up to 7 years. Tax authorities, they always have the right to go backwards and check if you have all the necessary information. And the last point is around clarifications. Basically, taxpayers, they have the right to go to FTA and ask questions about the application of the relevant clauses. There is also some wording around APAs. They can also initiate the discussion of an APA. So that's in a nutshell all about compliance. I don't know if Sarah wants to say something on this or Janet.
No, nothing. Thank you, Yanis. As Yanis mentioned, transfer pricing is very, very important, and it's something you're going to have to think about when it comes to related party transactions. There's a disclosure requirement at the time you file the returns. You may also be required to keep the transfer pricing documentation in place to support the transfer pricing position and the pricing you've agreed between the related parties. And of course, the corporate tax law is effective now, so you could ask clarification on different aspects of the application of the law, although there is some detail to be made available. So just to give you some context, I think these are a couple of my favorite quotes when it comes to tax. The first one is by Benjamin Franklin. This is absolutely correct. Nothing can be said to be certain except death and taxes. And Einstein also mentioned the hardest thing to understand in the world is income tax. And of course, income tax is a completely different level of complexity as compared to value-added tax. There's something that needs to be thought about. And to put that into context, I just wanted to make the next few minutes a little bit interactive and ask you a question, in terms of what you think. So if you go on to the next slide. There's a poll question. So I don't know how many of you are familiar with Jaffa cakes, but the question here is that, is it a biscuit, is it a cake, or does it matter? So I'll hand over to you guys. If you could actually participate in this poll question, what do you think? Just give you a few more seconds. So it looks like most of you thought that it was a biscuit, and some of you were like, why does it matter? The reason why this is important is actually this was the subject of a tax case, a value-added tax case actually in the UK. And the question was precisely this: is it a cake or is it a biscuit? Because if it was a biscuit, it'd be considered as a luxury food, which would attract value-added tax. On the other hand, if it was cake, cake would be considered as essential food, which wouldn't be subject to value-added tax. And of course, the tax authorities were arguing that it's a biscuit. McVitie's, the owner, was arguing that it's a cake, therefore it shouldn't be subject to VAT. The tax authority was saying, look, it's a biscuit. It looks like a biscuit. If you look at the packaging, it's packaged like a biscuit. If you look at where it's stored and you go to the supermarket, you'll see it's stored with other biscuits as well. On the other hand, McVitie's, look, the name, Jaffa Cakes, it's a cake. And they also baked a huge cake for the tribunal at the time to demonstrate it was actually a cake. One of the key things they pointed out was that you need to look at the moisture levels. So what happens to a cake or a biscuit when they go stale? Cake hardens, a biscuit softens. The court actually decided that was a cake, and they focused on what happens when it goes stale, the moisturizer levels, and again, it just shows that tax cases are complex. For value-added tax, they're a lot easier and to digest, and that's why we're giving these examples. But they involve complicated questions on the application of the law, and the answer is not entirely straightforward. The next one, do you think this is crisp, or do you think a potato crisp, or do you think it's something else, like, for example, cake or bread? What do you think this is? So handing over back to you guys. Okay, great. So it's just sharing the results. Of course, many of you thought, as expected, that it's a potato crisp. Unfortunately, the High Court in the UK in 2008 did not agree. So this was another value-added tax case before the courts, and the question was whether this is a potato crisp, which would attract VAT, or was this essential food like something else, like a cake or something, which wouldn't attract VAT. And the court actually decided that it was a cake. And they effectively said that, I think Pringle said that it had a mouth-melting taste, and it only had 42% potato content, and therefore it wasn't sufficient for it to qualify as a potato crisp. But you're not entirely wrong. A year later, the Court of Appeal decided that this was actually a potato crisp. So again, two respectable courts, different levels within a year, reaching different outcomes, and the Court of Appeal said, "Khalas, 42% potato content is sufficient, and therefore it's a potato crisp." Again, highlighting the fact that there can be uncertainty. What about this one? I mean, is a Subway sandwich, is it bread or is it something else? Okay. There are the results. It looks like most of you said, of course, it's bread, and surprisingly large number of you said it wasn't. And you obviously took cue from the previous two examples. I could see that. Otherwise, I'm sure most of you would have said, of course, it's bread. It looks like bread. And again, this was another case in Ireland, and the question is whether it's bread and it should be subject to zero rate or it should be vatable. And in this case, the answer was a lot more straightforward because there was specific legislation defining the amount of sugar content which was required in order for it to qualify as bread, which would be subject to 0%. I think it was around 10%, and it had more than 10% sugar content, and therefore it wasn't bread. See, look, all three questions, most of you were on the wrong side. So there is a lot of uncertainty. We can move on to the next slide. When it comes to the application of tax legislation, and as I mentioned, the tax legislation for corporate tax is significantly more complex. And this comes on to my first point. Corporate tax is going to be a new law. Federal tax authorities been there for some time. They've been enforcing federal taxes, value-added tax, excise tax. Corporate tax is going to be new for them. We've had the legislation which has been published. There's still a lot of detail yet to come, but it hasn't been applied yet. And with any new law, there's always uncertainty. So you have to really understand the rules, how they apply to you, identify those uncertain positions, document them, and take a decision on what approach you're going to adopt. I think another lesson in terms of businesses with historical taxes has been that they've always waited too long. When it came to value-added tax, the law was issued in August 28. The regulations were issued at the end of November. A lot of businesses waited to the end of November. They said we wanted to see the regulations, and it gave them 1 month to prepare. Whereas the introduction of VAT and corporate tax is a significant business change. It impacts your entire organization. You have to look at everything from a legal perspective, financial perspective, your contracts, your historical contracts, new contracts, in terms of your invoicing, your IT systems. Are you ready to implement them? There's a lot of work to be done, and also in terms of planning. So of course, the first thing you need to do is do an impact assessment, understand what the rules are, how they apply to you, what you need to do, what changes you need to make, what gaps are there between now and you becoming compliant that you need to address in order to become compliant. And also, more importantly, what restructuring opportunities there are. Of course, every business decision has a tax cost, and sometimes you could legitimately restructure your business in order to take advantage of some efficiencies, which would otherwise expose you to excessive taxes or tax leakage, which can be avoided. And this restructuring takes time. You need internal approvals, you need stakeholder buy-in, you need to discuss internally, you need to enhance the training levels and awareness level within the organization. So there's a lot of work that needs to be done, which you need to do, and it takes time. So therefore, the key message is be proactive, act now, and you don't necessarily have to make decisions, but the thinking has to start now. We always recommend doing an initial impact assessment, and once further detail becomes available, then validating that initial impact assessment, because if you started the process early, it's a lot easier to validate than it is to do an impact assessment from the outset. And of course, if you do this early, you'll identify those restructuring opportunities and things which are making you non-compliant. There's a lot of practices which were in the UAE, which changed after the introduction of VAT, but some are still continuing. For example, you have two entities. The people sit under one entity, recording the revenue in another entity, and the other entity has no revenue at all. The invoicing between entities, transfer pricing. You're going to have to think about, what's your financial year? When do you register? What records do you need to keep? What elections do you need to make to benefit from exemptions? There's a lot of work that needs to be done. And you need to think about this now. Don't wait till the final rules. It will give you very limited time. Now, of course, if you're not compliant, it will result in a disruption to your business. And the other thing you have to think about is there is a general anti-avoidance rule as well. So of course, any restructuring, any decisions you make, there are some transitional rules you have to think about. You know, are you making a legitimate business decision, or is it an artificial decision designed to pay less tax? Because the general anti-avoidance rule may kick in. Move on to the next slide, please. Thank you. I think I've covered everything already over here. So there is a lot of thinking to do. You need to have a project plan, raise awareness, do that impact assessment, identify areas of optimization, restructuring, make changes to your IT system, review your contracts, have a tax policy in place. You know, ultimately someone will be responsible for tax at your organization. And if something goes wrong, you're going to be the person responsible. So it's good to have like a tax policy in place, a risk management framework, which gives you guidance, gives you protection. Any uncertain positions, document them. If you've done the right thing by obtaining an opinion, documenting it, and you could justify to your management, the tax authority, why you took that position. Think about transfer pricing and ultimately compliance. And again, you know, there's lots of applications that could be made, allowing you to benefit from reliefs, grouping, and you need to do that thinking now. So it just gives us a few minutes for questions. I mean, we have had a lot of questions and we will get back to you by email if we don't get the chance to address them now in the next few minutes. So if we could just go through some of the questions. So the first question is any plan for individual income tax by UAE government? If yes, when will it be? Expected date? There's nothing that we're aware of in terms of plans to introduce a personal income tax in the UAE. Of course, you know, there is another GCC country, Oman, which is proposing to introduce a personal income tax to the high net worth individuals. And things can change at any time, but at the moment, there's no concrete plan to introduce a personal income tax, and certainly we're not aware of one. I think there's a question here, what is the profit threshold for corporate tax? I think we discussed that already, 375,000, up to that, the taxable income will be subject to 0%. Above that, 9%. If you're a multinational corporation, which falls under BEPS Pillar 2, you'll be subject to 15%. And that's regardless of, you know, whether you're in the free zone or not. Is the law clear about the formation of PEs by foreign entities, or are there any ambiguities? And is it advisable for entities to check this every time they do business in the UAE? We already went through the criteria for PE. It's very much in line with international standards. So OECD guidelines are very, very relevant. But each time you do business in the UAE, of course, you have to think about, do you have a PE? Because you may not have a PE today. 3 months later, you may crystallize a PE. So it's not something which you could just assess on an isolated basis. You have to keep assessing. Because, you know, in order for you to have a service PE, for example, you need a 183-day presence in any 12-month period. So you're on a rotating basis, you have to keep checking, have I got a PE? And it's not even every year, because, you know, at any point you could have a PE, depending on how your activities change. There's a question, could you please elaborate on tax limited to worldwide income earned from business activity in the UAE? The question is not very clear, but as I mentioned, if you're a UAE resident company, you're subject to tax on worldwide income. So if you're resident, you're incorporated here, you're incorporated elsewhere, your management is here, you'll be taxed on income even from the UK, from any other country. You will get a credit for any tax you pay in those other countries. On the other hand, if you're not resident and you're non-resident, you have a permanent establishment, you'd only be taxable on the income which is attributable to that permanent establishment, which will be done through transfer pricing. And also if you have a nexus, and as I said, this could be a force of attraction with bringing additional profits within the scope of UAE tax. I think
we have a few questions on free zone companies. I think maybe we can focus on this.
how does, yeah. I've already addressed the question. I think I covered everything there is for free zone. So there's a question here, how does corporate tax apply to free zone entities? Is all their income taxable and only income generated in the UAE? As I mentioned, if you're established in the free zone and you have no income from the UAE mainland and all your income is from other free zones, and international income you're generating from overseas, you have no business in the mainland, you should benefit from 0%. The only question arises whether you'll be subject to any other rate other than 0% is if you're a multinational corporation, in which case the 0% rate will not apply. And if you're not a multinational corporation and you have income from the mainland, and again, our expectation based on what's already been announced is that if the income you receive from the mainland is limited to passive income, you should be able to continue to benefit from 0%. The only issue arises if you don't have income from the mainland, which is passive income and is non-passive income, then you will be subject to tax. The question remains whether on your entire income or only the income from the mainland, which is not passive income. So that question we do not have the answer for. As I said, the previous indication from the consultation document was that it would be 9% on your entire income if you receive even $1. Based on the current law, we don't know the answer, but there may have been a change in policy, which may mean that potentially your international and other income may be subject to 0%, and only the mainland income, which is non-passive income, may be subject to 9%. But I cannot confirm that with absolute certainty. That's my personal expectation. So that, I think, brings us to the end of our presentation. I hope you found this productive and useful. Thank you for attending. Please do scan the QR code. Okay, please do provide the feedback. We will share a copy of the presentation with you, and we will of course try to respond to as many questions that have been asked. We will keep a record of them. We'll get back to you as soon as possible. Thank you very much.